There are 4 items lenders look at when it comes to giving you a mortgage: income and employment, debt and credit, down payment, and the property you're buying. All of these 4 items are required when you're buying a home, but only 3, income, debt and credit, and down payment, are required for your pre-approval. The first and generally the most important item is income and employment. Lenders are required to verify that you can pay for a mortgage with your income directly dictating how much of a mortgage you can afford. For borrowers who work at a job, you'll need to provide proof of employment by a letter of employment or a pay stub. And if there's variable pay, like commission or bonuses, a 2-year history of your T4s. Now, if you're self-employed, don't worry, we can get you a mortgage here too. We must show a 2, sometimes 3-year history of your personal income tax statements and business financials. Lenders typically lend on personal taxable income, not business income, which makes tax planning sometimes a little tricky. There are programs available for those who may not fit traditional lending criteria. Now, I want to pause here for a moment to explain that documentation is everything. It's not enough that we explain to the lender that you can make a certain amount of money. We have to back it up with the proper documentation. One of our roles as your mortgage broker is to provide the lender with a positive picture of who you are and to prove that you're able to pay for your mortgage payments. At Pinsky Mortgages, we do this by requesting a complete documentation package to ensure that we can satisfy and prove your income. This is especially important when it comes to self-employed individuals. The second thing that lenders look at is debt and credit. For debt, lenders are looking at any outstanding balances you may have. Do you have long-term credit cards or lines of credit that you don't pay off? Or do you have any student loans or other loans outstanding? What about a car payment? These debts are all factored into how much mortgage you can afford. Credit can be simple. Do you pay your debts on time? If you've been late on your credit card bills or you've missed a few car payments, this could hurt your credit score. Maintaining a minimum score is required to get a mortgage. In many cases, an easy-to-achieve score of 680 is an acceptable credit rating for your mortgage. Third, lenders want to see how much of a down payment you have, and also a 3-month history of where the money has resided. In Canada, we're required to show a copy of your bank statements or investment statements so that the lender understands the source of your down payment. If you've had money deposited into your account from various sources, or you've moved investments around, down payment can be by far the most cumbersome part of the mortgage process. We have lots of experience helping our clients satisfy lenders' down payment requirements. As long as there's valid explanations for where your money has come from, there shouldn't be any issues. Lastly, lenders want to make sure the property you're purchasing or refinancing is safe to lend on. They're specifically interested in the property's value and the physical state of your property. For purchases, lenders almost never ask for inspection reports, but they do want to see property documentation describing the property. Specifically, lenders are looking to see if the property has any causes for concern, such as hazardous substances, mold, water leaks, and potential foundation issues. Unfortunately, it's common in British Columbia for strata or condominium buildings to have ongoing maintenance issues, where owners don't have the money for fixes or they choose not to spend the money for various reasons. Due to these issues, lenders have become more strict and further documentation may be required, such as a Strata Form B in British Columbia or status certificates in other provinces. Depreciation reports and engineering reports may be required, along with strata meeting minutes. For your property's value, the lender wants to make sure that the property you purchased is actually worth what you purchased it for. In most cases, they do this by requesting an independent appraiser to write a report stating that yes, your property's value aligns with the purchase price. However, in some cases, the lender may come back saying that they're happy with the purchase price and no independent appraisal is required. In this case, the property has passed the lender's internal valuation. They look at the type of the property, the age, price, size, and the location. Thank you so much for watching. I hope you've learned something today about what lenders look for when it comes to giving you a mortgage. I'm Eitan Pinsky at Pinsky Mortgages, a Vancouver, British Columbia-based mortgage team. If you enjoyed this video, please share it with someone who you think could benefit from the information. And if you ever have any home financing questions, please don't hesitate to contact me or any one of our amazing team members.